So as we're talking about value, maximizing the value, there's one thing that I'd like to discuss, which is kind of a little unique to the GovCon sector, which is for M&A, most privately held companies are sold as an asset deal.
Yep.
That is, the buyer comes in and buys all the assets, including the name and the reputation and the employees and all the rest of that. And they do that for a variety of reasons, one of which is a liability shield, but second is as that there's a stepped up tax basis for the buyer. GovCon is different, where GovCon companies are generally done as stock deals. Um, Now, those stock deals then are done, but the IRS being what it is, there is a provision that says, oh, did you do a stock deal? You can still treat it as an asset deal. And that basically increases the taxes of the seller, decreases it of the buyer. But in so doing so, the buyer's benefit is so great that generally they will pay the seller the amount of taxes that they are now paying that they otherwise wouldn't have had to, and even grossing up that difference. Are you seeing any changes in either sales or stock sales in either the GovCon or the non-GovCon sector?
I think it's all, that's a great question. And we have seen both deals. Some people prefer the stock deals. I would say buyers in general want to do an F reorg, that if you are an S Corp, they're going to expect you to do something called an F reorg, which is a reorganization to effectively a partnership or an LLC. And that is so that the buyer can depreciate some of the purchase price. They want that tax benefits. Now, I think a good skilled M&A advisor like yourself, Sharon, if that is the request, then the seller would receive less money. So there's a gross up, as you said, there's a gross up to kind of meet that tax benefit, or at least maybe split half the difference or something like that. So you kind of get ahead of that. Usually I see that in the negotiations. Now, if you can avoid the F reorg, if you can sell as an S Corp, there is a significant advantage in that your long-term capital gains tax treatment of an F reorg of a partnership will be 20% plus your net income tax, which is the extra surplus Medicare tax, which is 3.8%. So your federal tax would be 23.8. However, S Corp stock, when sold, is only subject to the 20% tax. It's not subject to 3.8. So in negotiations, if you're actually getting kind of forced into the F reorg, it's not just the tax benefits you're going to lose that they're going to gain from depreciation. It's you're actually now having to pay an extra 3.8%. So there is some math that needs to go into these negotiations, or you simply just ascertain we're not doing that for reorg. We're gonna stick as it's an all stock transaction, right? Maybe we reduce our price by a little bit and we split that tax difference. But there's just a couple nuances for the clients I have seen go as S Corps. It's nice. It's only 20%, not that extra 3.8.